All right. Hello, my name is Abby Nelson. I am a realtor at Remax 200 Realty in Central Florida. I have my own team and I'm here with one of my preferred lenders who is just a wealth of knowledge we go to all the time to help us decipher what's going on in a normal market and especially what's going on in this market.
Hi, I'm Mike Smalley. I'm with Waterstone Mortgage, and I have the pleasure of working with Abby's team and have for many years. And in these crazy times, the two of us thought it would be good to ask some questions and try to provide some answers to all the chaos that's happening in the real estate world and mortgage world today.
So let's start with that. What just happened?
Okay, so to me, the best way to explain it is starting really high level, kind of, a high level view of how the mortgage business works. Once someone understands that, then it's a lot easier to understand why some of the things have happened that's happened. So my company is a direct lender. We're owned by a bank. So we're a lender. We occasionally own a mortgage, and we also service mortgages. So when there's a mortgage originated, when someone gets a mortgage, there's three people that are involved. There's the originator, that's who gives you the mortgage, who you apply with. There's the investor, and that's who ultimately owns the loan. And in many cases, you have no idea who owns your loan because it's tied into a mortgage bond. And the third is the servicer. So in some cases, credit unions will be a good example. You go to your credit union, they originate the loan as the originator. They also own your loan because they're lending their own cash that they have from their depositors. And they're also the servicer where you make the payments to them. But most mortgages are not owned by the originator. Most mortgages, the originator originates the loan. So let's say that's us, Waterstone Mortgage. After the closing, we bundle thousands of mortgages together and we sell those mortgages to Fannie Mae and Freddie Mac, who are government entities that basically get with an investment banker and put all those mortgages into one pool, and it's sold as an investment called a mortgage bond or mortgage-backed security. So if someone looks at their 401k, for example, you have a percentage of your 401k that's in stocks, a percentage that's in bonds. Many of those bonds are mortgage bonds. So every one of us that has a 401k actually owns mortgage bonds. So there's the originator, which will be us. There's the investor, which is through Fannie Mae, the bondholder, and then there's the servicer, which is the company that you make your payments to. And that could be us who originated the loan, or we could sell the servicing to another company like a big bank like Wells Fargo, for example. So there's three companies involved. The end investor ultimately determines what the guidelines are. So Fannie Mae and Freddie Mac and Ginnie Mae, which is FHA and any government loan, VA, they set underwriting rules. And the originator has to follow those rules. So when we originate a loan, we have to make sure it meets Fannie Mae, Freddie Mac, or FHA rules. And in a normal market, it's pretty simple. Some originators might be a little more risk averse. So they might say, I know Fannie Mae says that 620 is their rule, but we might want a 660 because we want to be a little more conservative. And so some banks might do that. But for the most part, that system works pretty well where everybody agrees on what the rules are. And the middle person, the servicer, their job essentially is to collect the payments from the borrower and forward those to the investor, so the bondholder. And rarely do they really care about the rules and guidelines in a normally functioning market. Everybody is kind of on the same page. Where things have started changing today is the servicing market was what imploded probably isn't the right word, but was most affected early on in this crisis. So if I'm going to buy the servicing of a mortgage, it cost me about 1% of the mortgage amount. So I spend $2,000 to buy the servicing of a $200,000 mortgage, and I'm going to earn about $600 a year being the middle person, collecting the payment from the borrower, giving the money to the asset holder, Fannie Mae or the bondholder. So I need to keep that loan on my books for about 3 years and change to break even. In the last couple of years, as interest rates have come down, many companies, banks, and many non-banks have gotten aggressive into the servicing business because with interest rates at historical lows for many, many years, the general thought is most of those loans are going to be on their books for 5, 8, 10, 12 years or longer. So if 3 years is my break even and I own that servicing for 10 years, that's a really profitable investment for a company to service the mortgage. With this significant drop in interest rates that we've had here in the last couple of months, you can imagine what those servicing portfolios are doing, because 30%, 40%, maybe 75% of those people are all trying to refinance right now. So if I have a $100 million servicing portfolio, 30, 40, 50, maybe $70 million of that could be trying to refinance today. And as the servicer, I'm going to try to keep as much of that as I can without losing it, but I can't keep it all. So a lot of that's going to go away. To compound matters further, most servicers have borrowed money to increase their servicing portfolio. So rather than spending $100 million in cash, they might have spent $20 million in cash, and they might have borrowed $80 million to buy that servicing portfolio. So to them, that was not a risky move when they anticipated those loans being on the books for many years. And now what's happening is all those loans are getting refinanced. So my $100 million servicing portfolio is now worth $60 million, and I owe $80 million against it. So what's happening is my investment banker who lent me the 80 million is calling me and say, hey, Mike, I know you owe 80 million, but the servicing portfolio value went down to 60. I need to give you what's called a margin call, which means I need cash because you have to bring that line of credit down. So at the same time, when I'm losing all of my servicing and I'm losing revenue, I'm also getting hit with a margin call, and I have to put up additional cash to pay my line of credit down. And it's almost like for a homeowner, if you have a $100,000 house in an $80,000 home equity line of credit against your house, if home values went down to 65,000, and us as a homeowner getting called by the bank and said, hey, your home value went down, you need to pay your loan down by $30,000 today. So that's made a huge cash crunch on servicers to the point where they don't even want to buy servicing anymore. So when the originator originates the loan, even if they have an investor to buy the asset, buy the mortgage bond, they can't find a servicer to act as the middle person to collect the payments. So if you're a servicer and you're bleeding cash on a daily basis, you still need to continue operating and try to buy new servicing. But with the limited funds and the risky climate that you're now in, you're going to go as safe as possible. So high credit score, big down payment. So anything non-traditional, high debt to income ratio, lower credit scores, jumbos. There's some alternative income verification stuff that's kind of come back that we don't really do much of, but people it's out there. All that stuff almost came to a screeching halt overnight, like literally just stopped because there's nobody to buy it. And the end investor doesn't want to buy those either, because, and before we jumped on the recording, we talked about unemployment. If unemployment's going from 3 to 15%, then the end investor doesn't want to buy something that could default, because then they take a financial hit. So it's almost been like the perfect storm of things happening in the last really 3 weeks out of nowhere, just one big hit, and all of a sudden everything that's not plain vanilla has almost come to a screeching halt.
Like hot potato, who's going to end up with it? Now they're saying, no, we don't.
Well, and so we saw this week, so all of our investors over the past week have started changing guidelines, raising credit scores, lowering debt to income ratios, making changes. There was one company that was still doing not what they used to do, but they were going higher on debt to income ratio or lowering credit score than other people. And that lasted about 48 hours, because when everybody else stopped, every loan that didn't meet the normal criteria was going to this one bank as the end investor. And so we call it adverse selection, which basically means that you get everything that everybody else can't do, the hardest, the most challenging, the riskiest loans all went to this one bank. And 48 hours later, they're like, whoa, this was not what we wanted. So last night, not only did they go back in line with where everybody else is, they actually went to a higher credit score requirement and a lower debt income ratio requirement. So they almost like overreacted. But yeah, like you said, it's hot potato is a good example because nobody wants to be the one that's not in line with everybody else, because then you're going to get the stuff that you really can't handle anyway.
And it's so interesting because from a realtor's perspective, like if I get an offer, and we'll go into this a little bit more later on, and I see that that pre-approval letter is from the beginning of March, for me, that no longer applies. It's no longer valid because their whole lending criteria, what they could have been approved for
Yep.
30 days ago, drastically has changed. So that's something that agents definitely need to be on the lookout for.
Right. Well, we had, so in the last, week or so ago, it was FHA tightening guidelines, and out of nowhere, things are getting tighter. There's three investors that we do a lot of jumbos with. Two are big national banks, and one is our own bank in-house. And one of the two big national banks last night basically emailed and said, hey, we're shutting down our jumbo program effective tomorrow at 5 o'clock. So if you have anything that's not locked, tomorrow at 5, lock it in, otherwise it's gone. Thankfully, that didn't really affect us like the FHA stuff did, but it's just a general indication that, people are getting tighter. And then once somebody does something, other people try to catch up and maybe take it a step further. And then it just becomes kind of a race of, getting more and more conservative. Like I mentioned earlier, it's going to get tighter before it gets better. It hasn't affected conventional underwriting yet. And I'm a little bit worried that you're going to see the debt to income ratio on conventional loans tightening up a little bit.
Tightening up as well. So I guess, and you kind of already answered some of this. What's the biggest impact on FHA? And it's just the criteria has gotten more strict.
Yeah, credit scores have to be higher, debt to income ratio has to be lower. It's just kind of an overall, and the problem with that happening, so conventional is a better program for people if they qualify for it, but it has a little bit tighter underwriting requirements, so not everybody meets conventional's guidelines. If you don't, FHA was kind of the backup plan for, could be debt to income ratio or credit score, or maybe a more recent like bankruptcy or foreclosure. FHA had some looser guidelines there. So the mortgages that were FHA typically had one of those things. And now that FHA is tightening up, we probably 20 to 25% of what we did was FHA. That might go to 5% for the next 90 days until things get back to normal. Because
that's what we saw back in 2008. It's just the lending criteria just tightened up.
Yeah.
Because they want to make sure that they're going to get, paid back on the loans.
And just like now, it's kind of a race to see who can become the most like the tightest underwriting guideline to be the most safe and secure. I think on the coming out of this, whenever that is, hopefully sooner than later, I think it's going to be, well, I don't want to go first. I'm going to let you go first, see how you do, and then I'll follow. So it's going to take somebody saying, all right, we'll take the lower credit score FHA stuff and almost like sticking their neck out there before other people will follow on. But, it'll take longer to get back to normal than it probably should, because I think people will be conservative of being the first to kind of put their foot back in the water.
Sure. And can you tell me, how has this impacted VA as well?
Yeah, I personally think that so the challenge with VA, and we have an office in Destin, and it's right outside of Eglin Air Force Base, which is one of the biggest Air Force bases in the world. And so the majority of the clients we have up there are active duty, military orders. They get orders and they're transferred into that area. So VA has the same requirements as FHA as far as tightening credit scores and debt to income ratios. The challenge and my fear with that, so let's say you have a family, and let's say the husband's in the military and they're getting transferred from North Carolina to Florida to work and they're at Eglin Air Force Base. So, and let's say that the spouse traditionally has worked, but that income is going to trail. The husband who's active duty gets transferred, they get settled and stabilized, and then the spouse goes out and gets a job, right? Because they're usually pretty quick transfers. Like, we people come into town looking at houses and they're closing 3 weeks later. Well, if I'm only using the active duty military's person's income, their income might make their debt income ratio 55 or 60%.
Right.
But with good credit, with VA, that's not a problem. It qualifies fine. And we all know that there's more income that we're not using because the spouse hasn't got a job yet in the new city, and I can't use her income from North Carolina. So, but for us, we don't really care. No big deal. They qualify with just his income alone. Now with these tightening underwriting guidelines, like I call it real world debt to income ratio versus underwriting guidelines debt to income ratio. If that spouse hasn't got a job and they're planning on it, we can't use that income because they don't have a job yet. So
Right.
even though financially they're not putting themselves in a pickle, it makes the debt to income ratio seem a lot higher than it really is in the real world. The spouse just hasn't got a job yet. So I worry about that with active duty military. But in general, VA guidelines are similar to FHA as far as credit scores.
Just tightening it all up.
Yeah.
Now, talk to me about appraisals. Both, are you seeing a lot of drive-bys being allowed, and are you also seeing appraisers start to try to forecast where the values might be headed?
Yeah. So we haven't seen an issue with appraisals coming in low or appraisals like appraisers anticipating declines in home values like they maybe saw in 2008. They're taking longer because number one, they're crazy busy. I mean, there's a ton of business happening right now with purchases and refinances with rates so low. So appraisers are busy, so they're taking a little bit longer. Fannie Mae, Freddie Mac, and FHA have all come out with guidance that has allowed for what's called a drive-by appraisal. And actually, it's a desktop appraisal. They don't even have to drive by the house.
Okay.
They have to make an attempt to get access to the home, but if the seller will not let the appraiser into the house, they have to notate that, and then they can do a desktop appraisal, which is, I mean, really, if you've ever been to an appraisal before or had an appraiser at your house, they're not there for more than 5 minutes usually. They're a couple pictures, they test the water, and they're in and out. Sometimes they're there for 30 minutes. So what they're going to do is they're going to use the photos from the MLS to see the interior of the home because the interior condition affects the value. But most of what the appraiser does is at their computer anyway, looking at comps online and working through their grid to compare one house versus another. So that part of their job doesn't change. If they can't get in the home, they'll just use the photos off the MLS rather than the photos they take themselves.
And that's where it's helpful. Like right now with the marketing, we've always done. It's just we're really relying on it a lot with our Matterport and the virtual walkthroughs and the 3D tours. I'm sure they can see everything as though they were there. So they're probably just able to use that and really get a good.
Well, that's, there's a big difference between like what your team does with photos and what some realtors do with photos. I mean, some realtors like grab their iPhone and it's like, it looks like it was taken like in 1975 and you can barely even tell the condition of the home, interior and exterior. So, I would say as much as more than ever, quality photos for the listing will have increase in the likelihood that your house appraises. So if you're a seller, you can't work with a realtor that's not going to make the home show well with the photos because that's basically how it's going to be appraised now.
So I can comfortably tell my sellers if you're not comfortable having the appraiser go by, as long as you just tell them you're not, then they can still keep moving forward, but the seller has to actually tell them that they're not comfortable.
Yeah, it has to be communicated to us somehow. Maybe when they call to schedule it, it's communicated, but they want the appraisers to make an attempt, and if they can't get in there, then
they're allowing it.
Yeah, the government guidelines have kind of, they've loosened up. I don't know how long that's going to, I mean, I would imagine that's going to last as long as this crisis,
Sure.
lasts, so that'll end at some point. But, as long as we're in a Zoom meeting world, I think they'll continue to allow that.
They'll continue to. And I mean, I'm sure as far as timelines of contracts, you're just seeing that things take longer in the lending world.
Yeah, I mean, a little bit. I mean, I was talking to one of the guys in the office who's 2 doors down from me. He has a closing this week that is closing in 12 business days, 16 calendar days. So stuff still can close quickly. I don't think the time frame is that much longer than it was before. A little bit longer for the appraisals, but it shouldn't take a whole lot longer than it has. I think some of the logistical things are harder, like getting inspections and appraisals scheduled and scheduling the closing and how do you go to the title company and what does that look like. So there's some logistical challenges, but time frame wise, things really shouldn't take
Because
any
I mean,
longer.
the lending component has almost always been, a lot of it's remote, scan and send documents, upload to this portal. So
Yeah.
y'all are able to keep things moving forward. Okay. And I mean, I know you, like you said, you think it's going to continue to get tighter, but are you seeing any further changes in the future? Any additional steps and hurdles we're going to face?
I don't think you're going to see specific things as much as just kind of a general aversion to risk. So if the FHA was early on and some of the non-traditional income, because that's just risk aversion with the servicers and the end investors. If you see unemployment spike, like if this lasts longer, if in May we're kind of back to normal, then it's not going to get a whole lot tighter. If we're talking July 4th and we're still doing Zoom meetings and can't see people face to face, you're going to see conventional guidelines tighten up because there's going to be worried about higher unemployment and defaults and things like that. So the faster this goes away, the more normal underwriting guidelines will be.
Like the rubber band effect, the faster we can rebound back to things.
Yeah. Yeah.
Okay. And let's talk a little bit. I know the other day we called you and said, hey, when we're getting offers for our sellers, we as agents, we always call the lender before if we can, before we can even present the offer, but before we really want our sellers to counterback, negotiate, or definitely accept that offer. And we ask a whole slew of questions. And so I know the other day we reached out to you and said, okay, what should we be asking differently than we usually do to really vet the buyer and make sure that, as best as one can predict, right, they're going to be able to, close this deal.
So what you're trying to do there is you're trying to anticipate like future problems that might arise. Other than the things you guys already asked, like, where do they work? What do they make? They've been on their job for a while. How's their credit? Do you have their documents? Things like that. I think, asking what industry are they in? I know we're doing calls with our whole team every Tuesday and Friday morning, just because it seems like every couple of days there's something new going on. So we had 50 of us on a call this morning. I told everybody we need to be looking at all of our borrowers that are closing in the next 30 days, and we need to look to see where they work. And if they're in an industry that we're worried about, that doesn't mean that we're going to tell them we can't do their mortgage. I mean, I hope nobody gets laid off. Right. But I had a client who called up this week and she's getting furloughed and her last day was last Friday. And we were able to make it work. We took her off the mortgage. The husband's income was enough. They had to pay off the debt. They put a little more money down. We had to get creative. But anyway, it's going to work, and it's going to close. So we're trying to anticipate what industry is somebody in. And if somebody's in the hospitality industry in Orlando, that there's a good likelihood that person's going to have, if they haven't already, some type of reduction in income, whether that's lose their job altogether or furlough or reduced hours or something. So we're trying to plan, okay, if this person gets their hours cut, can we still help them out?
Right.
So with on the listings, that's I had a realtor ask me this week, what industry is somebody in, which that was a really good question, because that's an indicator of what could happen.
Right.
So we're trying to anticipate what could happen, just so if it does, we know like if it happens, is that a dead deal altogether, or if it happens, is there a way to keep it alive?
And agents that are working with buyers, I mean, you should be asking these same questions because you want to protect your client and know that if you put them under a contract, that they'll be able to perform and move forward. That's one of the quirks right now that we're dealing with, and I've been watching, webinar after webinar. Just our contract isn't built to handle this scenario really well. And so we really want to just anticipate as much as we can to make sure that our buyers and sellers on both sides are protected. And I think we talked about also asking what their credit score is as well.
Well, that's big, because if it's a lower credit score under 660, those tend to more likely be FHA mortgages. And we all know that of all the programs, that's really the one that has been the most impacted.
And that's where, for us, communication is just so important. And we know that when we get on the phone with the lender, that, will really explain what's going on to us, talk to us about the client. It gives us a much better sense of ease of moving forward with that customer. Versus, if we have a lender that says, I'm not telling you anything, then
Right.
it raises red flags for us representing a seller. And so communication, it's just so important, and for us to really all work together right now, just to really do our best to get everything moving forward for our clients.
Well, I think as a homeowner, it's more important than ever to, I mean, it's always important, in my opinion, to work with a professional realtor, because there's so many, that just don't have the experience that you guys do. But I mean, I saw your Facebook post that you had a 3 listings this week and multiple offers. Stuff's still happening. Like we're having this month will probably be our biggest month ever, even with some transactions falling out because people losing their jobs. So stuff's still happening. It's just, you have to be more resourceful. You have to be able to get creative and figure out how to be a
Yeah,
problem.
what did I say the other day? I said, we're doing nothing different, but everything differently, right?
Yeah.
So
Yeah.
we're still moving forward, but obviously in much safer manners, just distancing completely. I don't think I've left this chair for a few weeks now. So
Yeah, I'm coming to the office because it's just hard for me to be focused at home. And we have 55 or so people here, and there's about 8 of us that are coming to the office. So
right.
I have about 1,500 square feet of personal space. So, but it's different. My whole team is at home.
Yeah.
But we're adapting. We're doing Zoom meetings at 8 o'clock every morning, and stuff's still happening. Like you said, it's just different.
Yeah, there are definitely things I'm going to want to take from this and continue to use. I mean, I'm really getting a lot more comfortable with virtual listing appointments, and so it saves me drive time on many occasions. So a lot of things that will come from this that are good. Let's end on kind of some predictions of what you see happening in the market as far as values and things like that.
Abby, before we get into that, can we talk about the forbearance programs a little bit?
Yes, thank you. That was the other thing we did want to talk about.
So, the president and any political leaders have announced, X number of months forbearance, don't have to make a mortgage payment. So it's an election year. Every politician wants to be seen as consumer friendly. So the politicians in DC are all over some type of, you don't have to make a payment scenario. There's a big difference between forbearance and deferment. So deferment means I can delay making the payment, but forbearance is a short-term gap. There was some stuff going around in social media last night. Somebody posted an actual forbearance letter from a lender, and you have to be really careful because many times at the end of, let's say, a 90-day forbearance, you don't just start day 90 like you're paying $1,500 a month again. In many cases, you have to pay the 3 months that you skipped and the month due all at the same time. So if you're paying $1,500 a month, you can.
Can you come a little closer to the mic? Got a little. There you go.
Yeah.
Thanks.
So with many of the forbearance programs, let's say your mortgage payment's $1,500 a month, and let's say they're going to let you skip 3 months worth of payments. So April, May, and June, you get to skip your $1,500 payment. July 1st, in many cases, you owe $6,000. Essentially all 4 months, the 3 you skipped and the 1 that's due. So if you're thinking of forbearance, double, triple check, call your existing servicer and really figure out how that program works and what's going to be due. My recommendation is, sorry, my light went off, give a little wave. I have a motion detector in here. If you can afford to pay your mortgage, continue paying your mortgage. Do not stop. Only stop if you literally cannot pay it, because there will be repercussions, and it could be a large payment due. It could be an effect on your credit, but nobody really knows what the end result is. The government's put out some guidance. I talked about servicing earlier. So if I'm a servicer and you don't make your mortgage payment, I still have to send the payment that's due to the investor, to the bondholder. So if I'm a servicer and all of my borrowers quit making payments, there's only a short period of time that I can continue to forward that money on. The CEO of Caliber Home Loans was on CNBC the other day, and they're a direct lender. They service a lot of mortgages. They got 80,000 phone calls in one day about forbearance. And Caliber is a big company, but I mean, if those 80,000 people quit paying, there's only so many months that can last. So the Mortgage Bankers Association has asked the Federal Reserve to set up some type of lines of credit for servicers that servicers can borrow against to continue making those payments to the bondholders if the homeowner's not. But there's some unintended consequences, I think, of this forbearance. So just, if you can't make your payments, if you lost your job or were furloughed and you need help, obviously call and ask for help, but make sure that you ask all the right questions and you get it in writing.
Yeah, it's a double-edged sword, just because someone has to bear that burden. And again, the hot potato, who's bearing that burden?
Yeah. Yeah, and we can't afford to have all these servicers go out of business because, that would create additional ripple effects.
And then we go back to the banks lending directly.
Yeah.
Right, taking that risk. And how long, just curious, how long has it been since that's been the way mortgages actually worked?
Probably 30, 40 years.
Right. And there are still some lenders and some banks that do everything themselves.
Yeah, so credit unions tend to, like, we have a portfolio loan that we're the originator, we own the loan and we service it. That's probably less than 5% of what we do. And most lenders don't have a portfolio. The only people that would is if they're owned by a bank.
Right.
And it's usually a pretty small percentage of what they do. Some banks portfolio their adjustable rate mortgages, which how many people are getting adjustable rate mortgages right now? Not many.
Right.
So it's a pretty small fraction of the overall market.
So then let's go. Thank you for reminding me to talk about that. Let's go into kind of predictions, what you're seeing happening in the market, the values.
Yeah, so a lot of people want to compare the recession that we're getting ready to enter to the financial crisis. I think it's going to be more like the recession that we had after the dot-com bubble in 9/11. So if you look at the financial crisis, the things that are different today than they were in 2008, the biggest difference is real estate caused the last recession, and whether it was loose underwriting guidelines or lending to people that couldn't afford the properties and all the crazy exotic adjustable no income verification craziness that was going on. But real estate drove that bubble up and real estate caused it to burst. And that recession was all real estate related, and you had overinflated values. The average American had to make 25% of the median income in their city to qualify for a median priced home. So home affordability was very poor. The market needed to correct. Today, the average person needs to make 14% of the median income to qualify for a median priced home. So affordability is much better. And the quality of mortgages done in the last 8 or 10 years is much better. Fixed rates, income verified, things like that. So there's not a bubble right now at all. The economy was super strong. So I think this is more like 9/11, where one completely unexpected event caused a really nasty, increase in unemployment in a really short amount of time. And we saw it, yesterday, like 6 million more people filed for unemployment for the first time. And unemployment, the jobs report today was very poor, but that's a lagging indicator. So you really won't know how bad it is until May.
Right.
So I think this recession is going to be really bad, but hopefully really quick. And the impact on home values, I think, is going to be determined by how long it lasts. If May 1st, we're kind of getting back to normal and I can go start coaching my kids' travel baseball team again, then, we'll bounce back pretty well. Some of those jobs aren't going to come back. Companies that laid off 100 people might only hire back 80 or 85. But it'll get closer back to normal. But if we're talking, if it's July 4th and you and I are doing a Zoom meeting, on the day we're, not able to shoot fireworks off unless we're far enough from each other, then there's going to be, bigger impact because unemployment's going to last longer. So the quicker we get out of this, the less impact it'll have on values, I think.
The quicker we can get over it, right?
Right. Like after 9/11, it was very similar to today. It was panic, fear, unexpected. I don't want to go to Disney because I'm not sure if there's going to be a terrorist attack. I don't want to get an airplane. And the economy got really bad. But, by spring of 2002, it came charging out of it and the economy was really strong,
right.
for many years. So if we can get through this, then 3-6 months from now, things are getting back to normal. That's what we all got to hope for, is that it's a short, bad, recession, and then it's hopefully a quick recovery.
I agree. I agree. Well, thank you so much for your time. I appreciate it. I always appreciate your insight, and good luck to you,
Thanks,
healthy,
Becky.
and
Yep.
everyone else out there.
Thanks for having me on.
You got it.